Okay, let's try and unpack this. It is the morning of February 12th, 2026.
Right.
And if you've been watching the market since last night, you might be wondering if your trading app is, I don't know, glitching. We are looking at the Q4 2025 earnings report from AppLovin.
It is definitely a head scratcher.
Head scratcher is putting it mildly. Let's look at the setup here. AppLovin releases a report that by almost every single objective metric,
Revenue, profit, cash flow, guidance.
all of it, it looks like an absolute blowout, a grand slam. And yet the market looked at this data sheet and decided to just throw the stock off a cliff.
They plummeted
Yeah.
nearly 20% in extended trading.
It's a massive dislocation. You rarely see a gap this wide between the reported fundamentals of a business and, well, the immediate psychological reaction of the market.
Exactly. It feels like a paradox.
So our mission for this deep dive is to figure out who's wrong. Is the company, cooking the books with unsustainable numbers?
Or has the market just completely misread the situation because they're blinded by fear?
It's the classic investigative question. To get to the bottom of it, we've come through the Q4 earnings call transcript, the full financial data sheet, and the press release.
We need to separate the noise from the actual mechanics.
And before we get to the fear, because there is plenty of fear to discuss, we have to establish the baseline. We have to talk about these numbers because they are, well, they're staggering.
They really are. Let's start with the top line. Q4 revenue came in at $1.66 billion.
Which is up 66% year over year.
66% growth. For a company this size, that is already top tier.
It is. For the full year of 2025, they hit, what, $5.48 billion in revenue, up 70%.
Correct. But as impressive as that growth is, the revenue isn't even the main story here. The story is the efficiency.
Okay, this is where I had to double check the math. Adjusted EBITDA for the quarter was $1.4 billion.
But the margin, you have to contextualize the margin for everyone
It
listening.
was an 84% adjusted EBITDA margin.
84%. In the software world, you usually see gross margins at maybe 80%, but then you pay for sales, marketing, R&D. Right, all the overhead.
And your actual EBITDA margin usually drops to 20, or if you're lucky, 30%. How is an 84% EBITDA margin functionally possible?
It sort of defies the laws of physics for a normal company. In software investing, there's this famous benchmark called the Rule of 40.
Right, the Rule of 40.
The idea is that if you take your revenue growth rate and you add it to your profit margin, the sum should be at least 40.
So if you grow 20% and have a 20% margin, you hit 40. That's an A grade, a healthy, elite company.
Exactly.
So what did AppLovin score?
Well, their CFO, Matt Stumpf, he actually pointed this out on the call. You take their 66% growth, you add their 84% margin. They aren't at 40.
No.
They're sitting at a score of 150.
The rule of 150. That sounds like a typo.
It sounds made up, but it demonstrates extreme operating leverage. And this leads us to a concept called flow-through, which Stumpf highlighted. He said the flow-through to adjusted EBITDA was approximately 95%.
Wait, let's pause on that. Flow through. Break that down for me. What does 95% flow through actually mean for the business?
It means that for every single incremental dollar of revenue they brought in compared to the last quarter, 95 cents of it went straight to the bottom line as profit.
So their costs are basically flat. They made way more money, but didn't have to spend any more to get it.
Precisely. And that's because they aren't selling software licenses that require a big sales team. They're running an AI auction engine. Once that algorithm, their AXON engine, is built, scaling it doesn't require humans. It just needs electricity and compute.
It is the definition of a cash printing machine. And speaking of cash, they're not just sitting on it, are they?
No, not at all. They generated $1.31 billion in free cash flow in just this one quarter.
In one quarter.
And for the full year, 2025, they bought back $2.58 billion worth of their own stock, aggressively returning that capital to shareholders.
Okay, so let's just recap the pro column here. We have a company growing at 66%, with margins that shouldn't exist in nature, printing over $1 billion in cash a quarter, and buying back stock.
And the market responds by nuking the stock price by 20%.
It seems irrational. It seems insane. So we have to look at the con column. What is the market seeing that the spreadsheet isn't? This brings us to the bearish case, the fear.
Right, and really when you strip away all the noise, the bear case boils down to two main narratives.
Two fears.
One is existential, about AI, and the other is competitive, about big tech.
Let's start with the AI fear, because usually, in 2025, 2026, if a company mentions AI, the stock goes to the moon. Why is it hurting AppLovin here?
The fear is about commoditization. The narrative goes something like this. Generative AI is making it incredibly easy to code and create art. So the barrier to entry for making a mobile game is going to zero.
Meaning I don't need a studio of 50 developers anymore. I can just type a prompt into a model and poof, there's a game.
Exactly. So the bears argue that we're about to see this tsunami of low-quality AI-generated games flooding the app stores.
A flood of content.
If there are a billion games, the value of any single game drops to nothing. And if the game developers make no money, they can't pay AppLovin for ads. The ecosystem collapses.
That sounds plausible. It's basic supply and demand. If supply goes to infinity, price goes to zero.
It's a classic economic argument. But Adam Foroughi, the CEO, he takes that exact same premise, that content is exploding, and he draws the exact opposite conclusion.
Okay, he flips it.
He calls it the discovery thesis.
Let's untack that. How does a flood of garbage help him?
Think about it like a library. If a library has 100 books, you don't really need a librarian. You can just browse the shelves.
Sure.
But if the library has a billion books, and 99% of them are terrible, finding the one book you actually want to read becomes impossible on your own.
Right. The value shifts from the book to the search engine, to the librarian.
Precisely. In the old world, humans built games, content was scarce. In the new world, AI builds games, content is infinite. Adam argues that when content is infinite, discovery becomes the scarce resource.
The matchmaking.
The matchmaking, the engine that connects the right user to the right game, becomes the most valuable player in the whole ecosystem. AppLovin is betting that they are the librarian.
They control the search engine, AXON.
Yes. And the more noise there is, the more sophisticated that engine needs to be, and the more dependent creators become on AppLovin to find an audience at all.
That actually makes a ton of sense. If I make a game in a sea of a billion other games, I have no choice but to pay the gatekeepers to get noticed.
Right. But there was another angle to this AI fear, wasn't there?
Oh, yeah, the chatbot theory.
The idea that people will just stop playing games. That we'll all just be talking to AI chatbots for entertainment instead of playing Candy Crush.
I have to admit, I find that one a little hard to swallow.
Adam did too. He addressed it directly. He made the point that casual gaming serves a very specific human need.
Relaxation.
Exactly, relaxation. He said, and I think this is a key insight, that casual gamers aren't going to stop playing solitaire just to talk to an AI.
It's a different kind of entertainment. Sometimes you don't want to talk to a robot, you just want to match tiles while you wait for the bus.
It's the difference between reading a textbook and watching a sitcom. Different emotional needs. So he doesn't see AI replacing that desire to just zone out with a simple game.
Okay, so that addresses the big existential AI fear. But then there's the competition fear. And this one feels much, much stickier for investors. It's the shadow of Meta.
The fear of Meta is always there in ad tech. The narrative is, Meta has all the users, all the data. Why wouldn't they just eat AppLovin's lunch?
Specifically, I keep hearing this fear that Meta is going to bypass privacy rules.
Right. The worry is that Meta will use its massive social graph, the fact they know who you are because you're logged into Instagram, to bypass Apple's IDFA restrictions.
And IDFA, just to remind everyone, is that tracker on your iPhone?
The identifier for advertisers, the thing Apple lets you turn off now, which kind of broke the old advertising model.
And AppLovin's whole claim to fame was that their new engine, AXON 2, works without that tracker.
Correct. He uses probabilistic modeling. But the fear is that Meta will come in and bid deterministically. They'll know it's you, even if Apple says they shouldn't.
If Meta can do that, doesn't AXON lose its advantage?
Adam's argument is twofold. First, he thinks Meta would be risking a massive war with Apple if they tried that. It likely violates the terms of service.
A very risky game to play with the landlord of the App Store.
A very risky game. But the second argument is the one I found really fascinating. It's about the mechanics of the auction itself.
This is the bid density part. I want to drill into this because it's so counterintuitive. He claims that more competition actually helps AppLovin. How is that possible?
You'd think it's a zero-sum game, right? If Google or Meta wins an ad slot, AppLovin loses.
That's what I thought.
But Adam explains that it's not. You have to remember, Apple isn't just a bidder. They own the auction house. Their platform is called Ablix.
Okay, so they own the casino.
Right. Imagine AppLovin is running an auction for a billboard inside a game. AppLovin bids. Google bids. Meta bids. Maybe some startup CloudX bids.
Okay, competition heats up, prices go up.
Prices go up. Now, let's say a competitor bids $5 for that billboard. But AppLovin's algorithm, AXON, calculates that billboard is only worth $4.
So AppLovin steps aside.
They let the competitor have it. But here is the kicker. AppLovin runs the auction. So when the competitor wins that impression, AppLovin charges a 5% fee on the winning bid.
They're taxing their competitors for winning.
Exactly. So if competition heats up and people start bidding irrationally, AppLovin just sits back and collects a 5% tax on everything they don't win.
The whole pot gets bigger and their fee gets bigger.
And for the stuff they do win.
That's where they make the 84% margin.
Right, because their data says that slot is worth way more than the price they paid. So Adam's point is, heads I win, tails you pay me 5%.
That definitely paints a different picture than the doom and gloom stock drop suggests. It sounds like they have a hedge built directly into the business model.
They do. And that's before you even get to the part of the report that signals the biggest shift in strategy.
Breaking out of the gaming box.
The e-commerce expansion. They're calling it web advertising now.
This feels like the holy grail for them. I mean, if they can sell shoes and frying pans the way they sell video games, the market opportunity just explodes.
It does. And they finally shared some concrete details on how it's going. The anecdote Adam shared about the Israeli cookware company was, well, it was telling.
I loved this story. Tell us about the cookware.
Okay, so there's this cookware brand. They started with about $4 million in revenue. Small player.
Tiny.
They started using AppLovin's platform for user acquisition to find people to buy their pots and pans.
And usually a brand like that would stick to Instagram or TikTok, right?
That's what you'd think. But they shifted spend to AppLovin. They scaled to $16 million in revenue, profitably, and this year they're projecting to hit $80 million.
Wait, from $4 million to $80 million just by switching their ad spend?
Adam said AppLovin is now driving 65% of their user acquisition. It shows the AXON engine doesn't just know which gamer wants to play Candy Crush.
It knows which person wants to buy a non-stick skillet.
It's a massive proof of concept. But surely that's an outlier, right?
It has to be. What are the metrics looking like for the broader program?
So they launched a self-service pilot for this. And the metric that stood out was the LTV to CAC payback period.
Layman's terms, please.
Lifetime value to customer acquisition cost. It's how long it takes an advertiser to earn back the money they spent on an ad. Adam said they are seeing a roughly 30-day break-in.
30 days. In marketing, that is incredibly fast. Usually you're hoping to make your money back in 6 months, maybe a year.
If you could double your money in 30 days.
You just keep spending. You pour gasoline on the fire.
It's essentially compound interest for the advertiser.
Mm-hmm.
But, and there's always a but, there is a bottleneck.
Of course there is. What's holding it back?
It's not the demand, and it's not the tech. It's the creative, the ads themselves.
What do you mean?
Adam mentioned a breakage rate. Currently, 43% of the qualified leads companies that want to spend money don't end up going live.
43%. That's almost half.
What? They don't have the videos. AppLovin is a video-first platform. It relies on high-energy, engaging mobile video ads.
Gaming companies have armies of animators making these. A cookware company probably doesn't.
Exactly. They might have photos, maybe a TV spot, but they don't have the high-volume, mobile-optimized videos that the algorithm craves.
So the algorithm is hungry, the advertisers have cash, but they don't have the food to feed the algorithm.
That's a great analogy. And this brings us right back to AI again. AppLovin's solution is to roll out generative AI tools to automatically create these video ads for the merchants.
So you upload a picture of your frying pan and their AI makes a 30-second engaging video ad for you?
That's the plan. If they can solve that breakage, if they can get that 43% of advertisers live, that revenue growth could accelerate even further.
It really feels like they are building a completely enclosed ecosystem. They find the user, they make the ad, they serve the ad, they take the payment.
It's total vertical integration of the advertising stack.
So let's bring this all back to the start. We have a stock that dropped 20% on fear. We have a company growing at 70% with 80+% margins. A CEO saying, the market is wrong, look at my dashboard.
It means we are likely looking at a major dislocation. The market is pricing AppLovin based on the past, the fear of Meta, the fear of old ad networks dying. But AppLovin is positioning itself as something new.
A universal discovery engine for the AI era.
And they aren't slowing down. They guided for 5 to 7% sequential growth in Q1 2026.
Which is key because Q1 is usually a slow season for advertising.
Everyone has a spending hangover after Christmas. Growing sequentially meaning Q1 is bigger than Q4. That's a major signal of strength. It defies the seasonality of the entire industry.
It's a lot to digest, but when you look at that rule of 150, it's hard to ignore the execution.
Execution is the one thing they can control, and they seem to be doing it flawlessly.
Before we sign off, I want to leave you with a thought. We talked about discovery. If we are truly moving into a world where AI creates infinite content, infinite games, infinite songs, infinite products, does the power shift permanently? Does the entity that controls discovery eventually become more valuable than the content creators themselves? And if that's true, is AppLovin just a gaming stock, or is it trying to become the Google of the AI age?
That is the multi-billion-dollar question.
Yeah.
And the answer might determine whether this stock drop is a warning sign or the buying opportunity of the decade.
Something to think about. Thanks for listening to the deep dive. We'll catch you on the next one.